Hello and welcome back. My name is Mark Williams, and joining me is Francois Savary. Francois, hello.
Hello, Mark.
Thank you for joining us. It's good to see you. We're into the fourth quarter now. Let's take a step back and look at our portfolios and see if there's some rebalancing that can be made and what we should be doing. First of all, what kind of portfolio do you think we should be taking into consideration?
I think that the best portfolio is a balanced portfolio. That's the one that relates the more to people. You have other options in terms of strategy. You could be conservative or growth oriented, but I think that the balanced portfolio is typically what the people have in mind.
All right, let's take a top-down look right from the very top then. What is the context in which we find ourselves? What are the macro considerations we should be taking into account? And what are the assumptions we're making about those for the next 3, 4, 5 months?
The scenario, I would say that the main scenario is a soft landing scenario. Clearly, the market is pricing a soft landing scenario. It means a kind of Goldilocks scenario where the inflation remains under control. There is some kind of deterioration in terms of growth, but it's only going to be a minor deterioration, and it's not a recession scenario. Clearly, you can say that the recession or the stagflation scenario in the course of the last few months, the probability, at least in the head of investor, increased quite significantly because it seems that in the US, the economy is going along scenario of soft landing. Moreover, what you can observe also in Europe is that there is a stabilization in some of leading indicators, especially PMI indices. And those indices tend to show you that there is something positive looming for the economic activity in Europe in the second half, I would say in the next 6 months. So this is clearly a soft landing scenario that is in the head of investors right now.
And therefore, we're considering that the good ship United States is chugging along gently and dragging everyone else along with it, as we would expect, as we have been expecting the last 20, 30, 50 years.
I think that, this is a big assumption. And as I mentioned earlier, I think that the market, the equity market in particular, is really pricing this kind of best possible scenario, which is a soft landing. So people need to think when they consider their asset allocation for the coming months, if there is not too much price in the equity prices right now. The same way, people expect the Fed now to cut rates quite a lot by the spring of next year. Is it something that is reasonable? Those are the two assumptions that you have in the market: slowing growth but no recession, and the Fed is going to a lower interest rate. In my opinion, this is clearly something that is priced in the equity price level at current level.
Let's come to the portfolio mix then. Straightforward, bonds to stocks. What would you be expecting to be able to using for the next few months?
Yeah, I think that in this regard, there is clearly something that is strategic and tactical. I still believe that you need to be in equities more than in bonds, because I still have a lot of doubts about sovereign debt. Sovereign debt is a big issue. I think that we all know that the deficits and the debt level of many G7 countries is going to a level that is getting less and less sustainable. I think that on the bond strategy, this is something that we have put in place for quite a long period of time now. We have tended to avoid the sovereign debt issue, and we have tended to be on the credit side of the bond market. By that, I mean investment grade company or high yield. Lately, and when you look at what happened in the course of the last few months, there has been a significant reduction in the spread that credit offers you. So to my point of view, you still need to have a defensive position on bonds, and you can use it for investing in two other assets, which are on the one side equities, and on the other side kind of alternative investments in your portfolio.
Therefore, if you're giving a preference to equities, what should be the split between bonds and equities in the portfolio?
Okay, I give preference for the medium to long term. I still think that this rally is not over. There are clearly signs that in the very short term, as I mentioned earlier, you have a lot of positive elements that are priced in. It means that you could have some volatility coming back on the equity market in the very short term. Because the US equity market has gained 35% since April, and since then there was no major correction on the equity side. The market is running up, that there could be some consolidation on the market, and by that I mean a retracement of 5 to 10%. This is something that people need to accept in their allocation, even in the very short term. So when you mentioned the level, I would say you should stick around what is considered for you as a neutral level for equity exposure. Currently, I would say that in our allocation, the neutral level for equities in a balanced portfolio is 45%, and we are very close to that. We believe that there is no reason for you to really go out of this 45% or to increase the level of equity exposure in your portfolio right now.
If people agree with you that the Goldilocks scenario is priced into the market and fully priced into the equities market, what sectors should investors be going towards within the equities portfolio?
I think that you could look at some laggards. It's interesting what happened in the course of the last 10 days in terms of, for example, sector and also regional. Would mention the healthcare sector. Look at what happened in this sector in the course of the last 10 days. There is a reassessment of these sectors. This is also something that is benefiting to a market that has been really out of the radar for many investors, which is Switzerland. Look at the performance of the Swiss equity market in the course of the last 10 days. It's quite impressive. I think that you need to be more careful on what is the lucky stars of the rally of 2025, which is mainly AI. AI has performed very, very well, and I think that this is this is the main part of the market that could experience some consolidation because valuations are quite high, because expectation for earnings are quite high, because of the interest rates hypothesis. So I would tend to book some profit there and to put my money back into sectors that have been less investable, I would say, in the course of the last few months. Healthcare is one of this sector. I think that luxury is making a comeback. Also, it's something that you should consider. And I think that you should rotate a little bit into your sector. In terms of region, I believe that what is very interesting is what is happening with emerging market, what is happening in Japan. Over the course of the weekend, we had the decision of a new prime minister coming in, and the rally on the Japanese stock market is quite impressive this morning because people are really betting that Japan is going to move towards a policy that is going to be very expansionary in terms of fiscal policy. Those are kind of moves that we have made in the course of the last few months. We have increased our equity exposure to emerging market. We have increased our Japanese exposure in our portfolio. And this is connected to also factors that we have in mind for quite a long period of time, which is the weakness of the US dollar.
All of those investors who expect the new prime minister to reflate the economy have also bet against the yen. And the yen's gone down even more than the stock market has gone up the last few days. How would you deal with that?
I would deal with that. I would not be so sure that you will have such a weakness of the yen in the medium term. Because look at the level, the 30 bond yield in Japan, it's above 3%. This is something that is becoming, in a way, quite dangerous because it could facilitate repatriation of capital that fled Japan many, many years. Investors that went into a treasury and etc. When you have bond yield rising in Japan, it could be quite interesting to repatriate your money. So yes, there is a risk that the new prime minister is going to be keen in trying to avoid the BOJ to increase rates too quickly. But nevertheless, don't forget about this repatriation issue that could support the yen in the medium.
All right, let's take a look at commodities now. What do we do with our commodities?
The big winner is gold. It's an asset we are very, very positive on for quite a long period of time. We have quite a big exposure in our allocation. We believe that the rally is not over and that it could continue in the medium term. All the reason for gold to push higher. You can see that central banks buying gold. You can see that retail investors are getting into gold through ETFs. You can also see that the US dollar is weakening, and that one of the main support for the gold price is the fact that people want to diversify out of the US dollar. This is a trade that is going to continue to my point of view. And don't forget that when the Fed lowers interest rates, it means that the cost of opportunity of gold is lower, which is something that is positive. I would have, if I was an investor, would have quite an allocation to gold prices for the medium term.
Are you saying, therefore, that you wouldn't rebalance bullion, you wouldn't rebalance gold and silver, and you'd allow it to increase as a proportion of your portfolio?
We are running the profit. Yes, we are continuing to run the profit. We don't see any reason why you should lower it. As a matter of fact, big thinking, because remember that it's very interesting in 2025. January until April, you had a strong rally on gold. Then gold was nearly moving sideways for 2 to 3 months. We discussed the issue. Was it the end of the rally? Was it something? And so we decide, okay, we keep our position because we believe that all the macro conditions in place for the gold run to continue. I must say I was surprised by the extent and the rapidity of the movement since we were moving around the 3,400 level for quite a long period of time. I was surprised, but I still that to imagine that we can go above 4,000 in the coming months is something that is perfectly feasible.
What is your new price target for gold then?
It's above 4,000. It's maybe 4,200 by the summer of next year.
What is your philosophy in terms of rebalancing portfolios for the parts that have performed very, very well? So, for instance, gold, because a lot of people have a 5% rule. If it varies by more than 5% in terms of the allocation within the portfolio, they rebalance. Do you follow that principle generally?
No, not necessarily. In the case of gold, as I mentioned earlier, we had an exposure of gold that was above those 5% level. We discussed, and we analyzed the situation, and we say, do we want to reduce the gold exposure to the level that is theoretical in a way? We were at around 7% at the beginning of the year in gold. Do we want to go back to this 7%, or do we keep our profit and increase because the size of the exposure has increased? We decide to increase the size of allocation.
Coming to alternatives now. What is your thoughts on allocation to alternatives? So hedge funds, private equity, that kind of thing.
We have different strategies that are substitute for our underweight in bonds. By that I mean we try to find strategy. They can be bond strategy or other strategy that provide us with a return that is comparable to a bond, but that is not exposed to the bond market to a certain extent. So we have quite a significant exposure into hedge funds that are with gold. And so this is quite a significant chunk of our allocation. When it comes to private equity, by strategy and by philosophy, we do not invest in illiquid assets. This is something that we don't want to do because our clients are investors, they are entrepreneurs, and those people, they still have their risk in their company. We consider that we can offer them a service in terms of, okay, they want to be invested in private equity, in private debt, but then it's on an ad hoc basis. This is not part of our strategy.
If you wanted to replace bond revenues and bond income, which kind of hedge fund strategies would you be using therefore?
We have some, for example, we consider that real estate is part of our alternative investment. So we have real estate investment that can yield you something that is interesting compared to bonds right now. We have some strategy that are on the long short, but very, I would say, defensive long short equity side. This is the kind of strategy that we have.
And lastly, then Forex.
I defend for quite a long period of time. I believe that the US dollar is going to weaken. I could not consider that the 125 level is something that is reachable against the euro by the middle of next year because of the monetary policy in the US, because of the fact you have some economic numbers that tend to show that economic activity in Europe is improving. I believe that the real effect on the European activity, the German decision to increase spending quite significantly, is going to materialize early next year in the first half of 2026. I believe that there is a will by the US government to really make the US dollar weaker. I believe that there is a diversification tendency among central bankers out of US dollar. So for all these reasons, I believe that you should position your Forex exposure with the view that the US dollar is going to continue to weaken on a global basis. When it comes to the Swiss franc, which is part of our allocation, we have quite a lot of Swiss franc. We believe that the Swiss franc is going to remain a strong currency over the medium term. But nevertheless, in the very, very short term, I believe that we have reached a level where consolidation is underway and should continue. So keep a good exposure to Swiss franc in your allocation if you are a foreign investor is something that we recommend.
What about sterling?
This is not a currency I really do like because I believe that many people are very frightened by the euro because of the situation in France, but there is a huge difference between the French situation, to my point of view, and the British situation. In France, you have a political problem, which is the inability to have a majority and the difficulties that are connected. People get used to that. In the UK, it's a different matter. The current government has a huge majority in parliament. The big problem is that investors do not see a clear vision for what this government wants to do in terms of policy for the medium term. And I think that this is something that is going to continue to weigh on the British pound.
Francois, I think that's all we got time for. Thank you very much indeed, and I look forward to speaking to you next week.
Have a good week.
You too. Bye-bye.